One of the more frequently asked questions I get from my clients is, how do I get the income I need in retirement and pay the least amount of taxes? In this video, I want to share with you how to think about that and put yourself in a position where you have more control of the income that you get in retirement and potentially put yourself in a position where you do pay the least amount of taxes. But before we get there, subscribe to our channel, hit the notification bell so you're alerted to when we post new videos. I have over 30 years of experience in this business, and I want to share with you what I've learned and the conversations that I have with my clients so that you don't step on the same landmines that they may have. Now, I've said this over and over on this channel. I think our industry has done a lousy job of preparing you for this transition into the next chapter of life, which is retirement. The focus for so much of the messaging around our industry and from the advisors who are in this industry is focused almost solely on money management. And I think that is a real disservice to those of you who are transitioning, because the reality is that when you go into retirement, cash is king. Cash flow is the most important thing to you. Now, during your working years, what we call the accumulation phase, money management is probably the number one financial planning topic you should be addressing. You want to accumulate enough money so that you have the assets and the resources to generate the income you're going to need to pursue your retirement goals. But once you make that transition and move into what we call the distribution phase, the topic of money management goes from being top of mind from a planning perspective to being like the fifth, sixth, seventh most important element in the conversations we have with our clients. It is now about generating the income that they need, understanding the cash flow they do need to pursue their retirement, and then figuring out how to get it in a manner that they can feel comfortable that they can do what they want to do when they wish to do it. This is a process we call the creation of the income faucet. And most advisors missed this when having conversations with their clients, and I only say that because of the conversations we have with both clients and others who tell us that even as they go through retirement, the focus is still on money management. Now, I'll share with you a story happened just recently that will back up from my perspective what I just said to you. Someone who had just watched this channel had reached out to me and had some questions as she was preparing herself to go into retirement. And one of the items that she mentioned to me was that she has an advisor and is very pleased with this individual. So obviously my first question to her when we spoke was, if you have an advisor that you're very comfortable with, why are we talking? Is it just to get a second opinion? And her comment to me was very interesting. She says she's been using this particular individual for numbers of years, but this advisor's focus is just on money management. And she realized she needed much more than that, which actually goes back to an old Fidelity study that was out there that said that during your working years, Fidelity came up with a number that we had 2.5 advisors who were giving us guidance on finances during the time frame that we were accumulating money. Could be your advisor, your insurance agent, whatever it was, your landscaper, I don't know who it is. But when you go to retirement, their recommendation was, Fidelity's, that you have one go-to advisor whose specialty is in the transition into retirement. And that's where our business is, in that very specialty. So one of the areas that I think you may be missing, and you've heard it from your advisor if you've been dealing with one during your accumulation years, is diversification. Diversification is key in money management, making sure that you have the proper balance in the proper sectors. But what we talk about with our clients is diversification, but diversifying their retirement accounts so that they have more control over when they must take money out and how much in the way of taxes they are going to have to pay. So let me share with you that entire process with you right now. So the first step along the way to creating your own income faucet is to literally define what your cash flow needs are. How many of you have actually done that as we go into retirement? This is the key, because believe it or not, once you define your cash flow needs, you can actually back into how much risk you're going to take with your money management. All too often, I talk with people who are not sure whether or not they're taking on more than or enough risk on their portfolio, and not sure whether or not they're going to be generating the income that they're going to need. This is the most crucial conversation that we have with our clients. It is the number one topic that we deal with. Define what your cash flow needs are, what you need and what's coming in, and figure out what you're then going to need from your portfolio. Now, as a part of this, you also have to recognize that there are typically 3 different stages of generating retirement income. The first is those years before the age of 72 and your retirement. So let's say you retired at the age of 66, from 66 to 72. Why do I choose 72? Because that's your required minimum distribution age, and that's where we must start to force money out based on the IRS rules. So from 66, if you will, to age 72 is stage 1. From 72, let's call it to 80, or whenever you can continue to pursue your life, assuming you've got your health and gusto and energy. That's a second stage. And then the third stage is finally, what do you need in those last 5, 10 years or so? Once you understand this, then you can start going back to your portfolio and your different retirement accounts to understand where the income is going to come from and when. The second step is to identify how each of your investment accounts are titled. Why is this important? Because we need to identify in the third step and prioritize from which one of these accounts we're going to take the income and in which stage, so that we can reduce the impact of taxes as money is coming out. So I'm going to get to the next 2 steps, but I have a question for you. Are you truly prepared for this next chapter? Retirement. In my latest book, Don't Outlive Your Money in Retirement, we created a quiz. If you go to our banner, you can hit the button for the quiz. It's a quick 2-minute quiz, and as soon as you fill it out, I will score for you which one of the 3 retirement preparedness stages you are in. I'll get you a free chapter of the book and a couple of worksheets, so you have a better sense of whether or not you are truly prepared for this transition in life. So the third step along the creation of your income faucet is prioritizing which exact accounts and how much money is coming out of each in each stage. Now, between the age of 66 and 72, you may be better off taking it out of your personal or joint or taxable accounts, because the money that comes out of there is typically, not always, but typically less costly from a tax perspective than if you were to take it out from your pool of retirement accounts. Then in the next stage, we must take out the required minimum distribution. You can take a look at our recent video on that. And if you've watched that video, you need to take out approximately 3.6% at the age of 72 from your retirement pool of accounts. Now, what you have to recognize is, and this is where we get to the big question of whether or not you should convert your money to a Roth in order to zero out your IRA account so you pay no taxes. Herein lies the planning and the benefits of planning. For if you take money out of your retirement account beyond age 72, it's fully taxable. But if you had a Roth account and you were taking money out because you needed it, there would be no taxes. So this gets back to the whole concept of diversification, that you would want to have some personal accounts, some regular retirement accounts, and a Roth account if possible, if you had planned for this early on. So this takes us to the final step, which is really the conversation about converting to a Roth IRA, and should you? Now, the pluses to converting to an IRA: you're not forced to take money out at your required minimum distributions. The money that comes out, if you are the owner of it, there's no taxes on it. And the money still grows tax deferred. Now, the negative of it is if you've converted some money from your IRAs into a Roth and made that transaction, then you'll have to pay tax on the amount that you converted. Now, herein lies the conversation you must have with your financial advisor. At what point in your life should you be making this? Is it appropriate for you? What income do you need? And does it make sense to make this conversion? Because if there is going to be an upfront cost, you need to know that the benefit to you long term is in your favor. So if you take these 4 steps and create your income faucet, get away from just thinking about money management, you'll put yourself in a better position to have more control over your income and how much in the way of taxes you will have to pay.